NVIDIA may be surging ahead with impressive AI-driven revenues, but a recent $4.5 billion setback hints at deeper vulnerabilities. We've meticulously analyzed NVIDIA's fundamentals, financial resilience, hidden risks, and valuation. Stay tuned to uncover surprising insights crucial for investors. NVIDIA, headquartered in Santa Clara, California, leads the market in graphics processors and AI computing, powering everything from GeForce gaming GPUs and cloud-based virtual workstations to autonomous driving platforms, Omniverse virtual collaboration technology, and advanced data center solutions, strategically positioning itself at the forefront of accelerated computing innovation. NVIDIA's balance sheet signals financial resilience despite recent setbacks. The low debt-to-equity ratio of 0.1 reflects prudent leverage control, compared favorably to industry peers typically ranging between 0.2 and 0.5. Although the recent $4.5 billion inventory write-down linked to China export restrictions raises short-term concerns, management's proactive reuse strategies and substantial liquidity reserves offer sufficient buffer, enabling strategic flexibility for continued shareholder returns and growth investments amid market uncertainty. Here's a screenshot of the full balance sheet, cash, and securities. 53,000 top liabilities, 41,000 long-term debt, 8,000, highlighting strength resilience. NVIDIA's balance sheet shows outstanding liquidity and minimal preferred stock liabilities, but retained earnings appear weak compared to broader market benchmarks, suggesting caution for value investors. NVIDIA's latest quarterly results reveal a sharp drop in profitability, driven largely by a $4.5 billion inventory write-down in H20 chips, and rising operating costs from aggressive investments into next-generation infrastructure. However, the sustained surge in revenue highlights strong market demand for NVIDIA's AI-focused offerings. Value investors should carefully consider whether recent margin pressures signal temporary setbacks or deeper competitive and operational risks, especially given potential export constraints impacting future growth opportunities in China. Here is a screenshot of the full income statement. Revenue climbed to $44 billion, yet gross margin slipped to 60% from almost 80%. Lean expenses help, but this compression questions sustainable pricing power. Proprietary Bow score highlights NVIDIA's robust profit margins compared to both industry peers and the broader market, although its earnings growth shows more moderate performance. The latest quarter shows remarkable revenue growth, largely driven by strong demand for AI products, positioning NVIDIA ahead of competitors. However, the rise in inventory charges has constrained profit margins, reflected in the recent dip in net income despite rising sales. While management remains confident, substantial inventory costs signal potential margin pressures ahead. Investors should carefully monitor whether this operational efficiency can be improved, or if increasing competitive pressures could erode profitability further. NVIDIA's recent cash flow surged to $26 billion, underscores strong operational efficiency and disciplined capital spending, despite rising stock-based compensation and export-related inventory pressures. However, the cash flow yield near 0.7% is relatively modest compared to value-focused peers that ideally target above 3%, indicating investors should carefully assess whether the premium valuation realistically reflects growth potential and justifies limited cash returns. Here is a screenshot of the full cash flow statement. Operating cash flow hit $27 billion, yet reliance on accrued liabilities implies transitory boost, while $14 billion buybacks pushed cash change deep negative. NVIDIA delivered stronger than anticipated second quarter results, driven predominantly by robust demand in data center solutions, particularly for generative AI workloads and Hopper architecture products. The upcoming Blackwell chip architecture is expected to contribute noticeably by late fiscal year 2025. Margins remain strong above 70%, suggesting healthy pricing power. However, Value investors should note potential risks from competitive pressures in China and supply chain challenges. Positively, growth avenues through sovereign AI and enterprise transition toward accelerated computing offer substantial forward opportunities. Analysts project NVIDIA's net income could rise sharply to $183 billion by 2030, driven largely by strategic growth in artificial intelligence, while forecasted earnings per share demonstrate strong market confidence. Investors should carefully watch geopolitical risks, particularly export restrictions, as these could significantly impact achievable growth and valuation potential over the coming years. NVIDIA's profitability metrics outperform the majority of the broader market, yet lag notably behind its industry peers, highlighting potential concerns regarding relative competitiveness within its sector. NVIDIA's price-to-earnings ratio is higher than industry peers such as TSMC, indicating strong market optimism about future earnings growth potential. But its price-to-book ratio is extremely elevated compared to competitors, raising caution for value investors. Still, management's active share buybacks suggest confidence in maintaining healthy financial positioning despite possible volatility driven by geopolitical risks. Our proprietary Bow score reveals NVIDIA is attractively valued within its industry, yet significantly overvalued compared to the broader market, signaling caution for value-oriented investors. Our discounted cash flow analysis suggests a robust intrinsic valuation for NVIDIA at $148 per share by considering 2030 revenue forecasts of $1.62 trillion. Although strategic AI investments promise steady cash flows, achieving such growth relies heavily on effectively overcoming risks like trade restrictions, which could notably affect manufacturing and export potential. NVIDIA's proprietary Bow score shows strong valuation appeal versus industry peers, but appears only moderately attractive compared to the broader market index, suggesting limited value cushion. Analyst forecasts indicate strong upside potential driven by artificial intelligence growth, yet geopolitical risks could challenge profitability, reinforcing NVIDIA's strategic shift toward domestic manufacturing for sustainable performance. Our proprietary Bow score shows NVIDIA's analyst target strength modest against peers, but relatively favorable within the broader market, suggesting mixed confidence from industry analysts. NVIDIA's inventory write-downs and squeezed margins underscore tangible operational vulnerabilities amid a lofty valuation built on ambitious AI growth forecasts. With modest retained earnings, geopolitical exposure, and cash flow yields near 0.7%. Discerning value investors should closely evaluate sustainability and competitive resilience versus optimistic earnings projections. Make sure to watch another video from our Value Explorer series by clicking the playlist below.